Today, we are covering interest and dividend income, a critical topic for the enrolled agent exam. The exam requires you to know not just what is taxable, but exactly where and how it is reported. The trigger for reporting interest and dividends on Schedule B is a total amount exceeding $1,500 for either category. If a client has $1,400 in interest and $1,600 in dividends, they must file Schedule B to detail the dividend income. But not necessarily the interest. An exam question will test this threshold. For example, a question might give you a taxpayer with $1,200 of interest from a bank and $400 from a seller-financed loan. Because the total is over $1,500, Schedule B is required. The exam loves to trick test takers with tax-exempt interest from municipal bonds. Remember that this interest is reported on Schedule B for informational purposes. But it is not included in the taxable interest figure on Form 1040. A common trap question will list various interest sources, including municipal bonds, and ask for the total taxable interest. You must exclude the municipal bond interest from your calculation. Another key area is accrued interest. When a bond is purchased between interest payment dates, the buyer pays the seller the interest that has accrued up to that point. This portion is not taxable to the buyer. When the buyer later receives the full interest payment, they can subtract the accrued interest they paid. The exam will test this by providing a scenario where a taxpayer bought a bond and received their first interest payment. You must know to reduce the taxable amount by the accrued interest paid at purchase. A frequently tested item is the penalty for early withdrawal of savings from a CD. The exam will try to make you subtract this penalty directly from the interest income on Schedule B. Do not fall for this. The penalty is an above-the-line deduction for adjusted gross income, reported on Schedule 1 of Form 1040. Here's a shortcut to remember this distinction. The penalty isn't on B, it's on Schedule 1, setting your AGI free. Shifting to dividends, the main distinction tested is between qualified and ordinary dividends. Qualified dividends are taxed at lower long-term capital gains rates, while ordinary dividends are taxed at the taxpayer's regular income tax rate. To be qualified, the dividend must be from a U.S. corporation or qualified foreign corporation, and the taxpayer must meet a holding period requirement. This is a favorite exam trap. The stock must be held for more than 60 days during the 121-day period that begins 60 days before the ex-dividend date. Expect a question that gives you purchase and sale dates surrounding the ex-dividend date. If the holding period is 60 days or less, the dividend is ordinary, not qualified. Finally, be aware of how investment income impacts other areas of the tax return. For tax year 2025, a taxpayer is ineligible for the Earned Income Tax Credit if their investment income exceeds $11,950. An exam question might describe a low-income taxpayer with a modest amount of dividend or interest income that pushes them just over this limit, and you must know that this disqualifies them from the credit entirely.